very warm good afternoon to all of you. First of all, I would like to thank the organizers and Ramesh sir and Vikesh sir for giving us this opportunity to have this very important session for all of us. Because I feel that there are two health that are very important. One is our physical health, which we ignore to the most, because we keep taking care of the patient's health while ignoring our own. And the second is the financial health, which we don't have any idea about. Can we have a hand count of how many of you invest? Hand counts? Invest? Okay. So hopefully
Does putting in FD count as investment? No.
that's a part of it.
Okay, then. Otherwise, we don't know next option in investment.
So this is what we look at today कि कुछ तो सीख के जाएंगे जिसके बाद हमारे पास पैसा ही पैसा होगा and अच्छे से होगा. So I'll ask Anil sir to guide us as to why should you invest at all. जैसे Ankur sir was saying कि is putting money in FD all right? Because most of us has come from a background where our parents would just keep the money in FD or the grandparents would have done the same, and we feel that that's the only thing that we need to do. Anil sir, please.
Yeah, good. I think good afternoon, all. See, we have a different professions. So we are from the surgical profession or a medical professions. So for our first aim is to do the surgery and reach a level. It's very unfortunate that entire our education system, we don't come across with a finance literacy. So that is one of the reason why we think it's not our cup of tea. See, why to invest? So once you earn, at least you should protect your money first. Second thing, your money should grow. Important point is there is an inflation rate. You can see that. The inflation rate means like whatever the object you have or whatever you buy today, by 1 year, the cost will increase to 6%. That is called inflation. This is for the common man. But for us, the inflation is at least 10%. The reason is the way we live or way we run around. Or we spend money to our kids' education. So the money which you keep in a saving bank account, no, it may give 3 to 4%. That means it is less than the inflation rate. So that means your money is getting eroded year on year. It's not the same 100 rupees what is there in your pocket, the next year the same amount. The value is less. The amount may be the same, the value is less. See, that is one of the reasons why we have to start investing. There are simple way of, investing where we can earn at least 13 to 14% of money, which can beat the inflation. That means apart from protecting our own hard-earned money, we can allow to grow it. Compound we are going to talk about.
We are going to talk about index funds.
So you'll understand as we go further how this a small percentage of earning of 13 to 14 is not a small. You must have heard of the name Rakesh Junjunwala. He is the one of the main person in the stock market. He says if anybody is earning 17 to 20%, he is the king. And if anybody is earning 25%, he is the emperor. So that means the 13 to 14% what you earn is a good enough money over a period of time to accumulate. Thank you.
And I think over the talk as we progress, I'll tell you why making 12 to 14% is something I called as a birthright. I always tell my parents that instead of the gold chain that she gave me during my second birthday, if she would have gifted me the Nifty 50, I would probably have come by Rolls Royce. So this is where we need to change our mindset. And this is why this is important. So I had this question in the survey as well. The question is, what is the right time to start investing? So the right time to start investing was yesterday, right? The second best time to start investing is today. Because as soon as we start, the compounding journey begins. So this is where I have put the formula of compounding. You need not remember the formula. We took biology because we were hating the numbers, but one thing we can get is in the entire formula, A is the final amount, and if you see there is something on the exponential part which is number of time periods elapsed. This is what you need to learn. So anything that comes on the exponential end will have the highest impact on the last result. So if I say that, the conclusion is if you start early, that's the biggest advantage that you can have over anyone. And the problem that happens for most of us is we don't invest in our residency. We start investing when we become a young consultant, when our tax liability gets increasing, or we have children and then we see, okay, I need to do something for my children. But this is where time has elapsed. Now what you do is, you go on ways where you want quick money. And trust me, whenever you see quick money, there is high risk involved. And this is where you end up eroding your capital and you say share market is gambling, and this is not how it works. So what we'll learn today is how to grow our wealth slowly, steadily over a long period of time with lowest amount of risk. And I'll give you an example. There are two persons, there's person A and there is person B. Person A starts investing at the age of 18 years, okay? This person has some pocket money, he saves entire year, and at the end of year he does 50,000 rupees investment. Now this person invests till the age of 26 years, okay? And at the age of 26, he is in residency and his friends say, let's party, let's buy phones, let's do this and that, let's go on trips, and he stops investing. He says, you only live once and I want to enjoy my life, okay? But he forgets to take out the money that he had invested from 18 years till 26 years, 8 years span. And there is person B who starts investing at the age of 26. He is a late riser in this. And he invests 50,000 every year till the age of 60 years. 34 years he invests. What do you think? Who will have the more amount of money at the age of 60 years? To our mind, it feels that person B has invested more amount of money, he should have more. This person invested just for 8 years, but you'll be surprised to know the person A will have twice the amount of money that person B is having, providing both get the same rate of return. And this is why I say, you have to start investing early, otherwise you will just save your money for your children and you will keep on cribbing that we earn for our kids only and we are never there to enjoy that money. Can we move on to the next?
There is a point called a compound interest. There's a simple questions to you. If 1 rupee become a 2 rupees next day, and the 2 rupee become 4 rupees next day, what would be the amount in a month's time? As the day, each day doubling, can anyone guess? Guess. How many millions? Can anybody guess? So it is somewhere around 15 crores. See, if you see that calculation, no, the probably first 15 days, it's only few thousand. And if you go up to the 20, 25 days, it may be just nearing lakh. The last 5 days, where the doubling happen, it reaches the crores. That's what Tanmay is making a point. Even if you start a 5,000 per month in an age of 20, and continue for 15 years and stop investing, and that money become a crores at the age of 60. So early investing is always advisable to get the maximum compounding. Yes, Tanmay.
So I see a lot of young people also in the audience and I consider everyone young because you are here. So there is a rule of 15. Before we go on to mutual funds, I'll just spill the beans here. So the rule of 15, it says, if you can invest 15,000 per month, how many of you can do that? I'm pretty sure everyone would be able to do a 15,000 per month. If you can do the same for 15 years, and I assume that you're able to get 15% returns, that 15,000 per month will become 1 CR. So being a crorepati is no longer something which we are ambitious, but if you put that money in the savings account, it's not going to grow. So investing is very important, but before that, as you know, as we learn riding, accidents, we need to know where should we protect ourselves? And this is where the thing comes about what are the prerequisites that we should have before investing. Sir, would you want to
Yes.
shed a few comments on a health insurance, term insurance, and emergency fund?
See, some of the a basic requirement is like, these are the few things where they'll help in the emergencies. See, one is the health insurance. You should have, always have a individual, a medical cover. It's not a family cover. Even though individual looks little big, but you should have a individual health insurance. And there should be a term insurance, depending on the age, at least minimum of 1 CR or 2 CR of term insurance. And the last is emergency fund. At least for a 6 months period, you should be able to cover in any of emergency thing. So these are the basic things, we have to keep it aside. You should not think that these are the expenses. This is the basic requirement. Once you keep this aside, then you can think about the next step, what is our investment.
So just a few more points about this. Now, many people come to me and say, Tanmay, why do I want to put the money in health insurance when I am investing? I tell them, this health insurance is gonna take care of your needs. God forbid something happens to you. Now, market is suppose in a downturn and something unfortunate happens to you or somewhere in your family. Now you'll have to take that money in loss because you need that money. So this is why something sort of a health insurance is important. Similarly, term insurance, why do we earn? It's for ourselves and for our family. But if we see some unfortunate incidents happens with us and then our family is in a soup. So we need to have a term insurance which is at least 20x of our salary. Somewhere around a 2 CR cover is good. For health insurance, I won't spend a lot of time here. I have uploaded a detailed video on YouTube. You can check that out. I will share it in our group. So what you can do is you can have a 1 CR cover, wherein you can have a base policy, which is something called as the policy that will cover your initial expense of around 10 lakh, and then add something called a super top-up. Now this super top-up, what it does is it gives you an extended cover. Say for a 90 lakh, it will hardly cost you 1,000 rupees. So adding a base policy with a super top-up is a smart way to have a very big cover at a very low premium. So these are the things which you can focus on. And
One more point regarding the term insurance. Whenever you are taking term insurance, there is one clause called Marriage Women's Act. So always you choose that. Why means, see, any other amount in the bank, like if you have a debt or a loan, the bank people can claim that. But when you have a Marriage Women's Act, that the MWP, click it, no one can touch it. It has to go to your spouse only. It's only for the male who can choose that point when you're taking the term insurance.
now the next thing comes is, so in the last 3 days, I have had so many interactions with lots of seniors and juniors also. They said, Tanmay, मैं SIP में invest कर दूँ क्या? This is the most common question that I get asked. कि तन्मय मैं SIP कर दूँ या SWP कर दूँ क्या? But this is because you don't understand what the term stands for. So SIP means systematic investment plan. This is nothing but you are taking your brain out of your investment process, and this entire process, what it will do is, a particular date it decided, as soon as your salary comes to your account. So I call this as a SIP that is healthy for you. So we have 2 SIPs. One is a beer ka SIP, which may not be healthy for you. It may get you tipsy, but this SIP will help you. And this is like paying yourself first as soon as you get your salary. And ideal amount is somewhere around at least 25% you can do. We'll see how we can plan goals around it. But this is how it is. Why do we need to do a SIP? Is because you never know when the market is high. So another common question that I get is, probably sir would be getting the same as well, कि तन्मय मेरे पास 5 लाख रुपए है, I need to invest. Can I invest it now? So I say, sir, do you know the market is expensive or cheap? Because if you invest when the market is expensive, then probably this money won't grow at all or it will decrease. And that's a problem. So to avoid that kind of circumstance, we divide the money in small chunk And this money, this is all automated process. You just need to trigger the amount, ki this is the amount that I want it to be deducted. Now this money will get deducted every month, specific amount for years. This is what the entire process is. You can do it on stocks also, but we'll learn today how to do it in mutual funds only. So this is a graph that I had put in. So you need not know the graph. The market also works in a ECG-like pattern. Sir, how?
Just a point here, see like in the market, no, it is not a straight line up going up and up. So that's one of the reason why we have to invest a monthly basis or a systemic investment. You cannot find which is top or which is bottom. You cannot wait till it comes down to the bottom. So when you put in an SIP form, no, all these things will get even out, up or down. And one is called SIP. There is one more terminology called dip. That is, whenever the market falls, if you have an extra money, you can buy again. So that is called dip buying, SIP and dip buying.
So if you see here, let us look at the graph once. Suppose this is the point instance that you are here. In somewhere around November, if you see, November 2022, there is some peak. But if you see, there was a slight dip after that. So if you had invested lump sum amount at that point, you may have felt कि अरे यार market में पैसा लगाया डूब गया. But if you see long term, can you see a basic trend that it has been going up for a long period of time? So this is what SIP does. So you may invest in ups and downs, but it will average out. And what this average return has been for our index, that is Nifty, is around 12 to 14% in the last 30 years. So I say, if you, so this is a quote by Warren Buffett. He says that the knowledge required to create wealth over a long period of time is zero. How? Because they said you just put your money in index fund, it will keep on giving you average returns over a long period of time, and it would be somewhere around 12 to 14%. Inflation is 6, you are achieving 12, you have beaten the index. Congratulations.
So one more point to add here. So whenever what we are talking about the equity market investment, this equity, there are two terminology. One is called equity, another one is the debt products. So debt product you all know, like an FD. You know how much amount you are going to invest, what is the percentage of return, how many years you are going, or how many days you are going to keep, what is the final amount. This is called debt product. The equity is a different terminology. For example, you take one company. If you liquidate that company and clear out all the loans, what remains is the equity. So that is directly related to the movement of the stock market. So whenever you plan to invest in the equity, it is not a days or months or years. It is at least a long term. Long term means at least a 7 years. If you see this graph, if you put it in the peak, and next few months or few years, it may go down. But if you see over a period of 5 to 7 years, what Tanmay is telling, no, on an average, it will give 12 to 13%. Means, if you invest today in the top, it may go down next year. Your portfolio may be minus. But if you keep investing for a period of at least 7 years, the average return is around 12 to 14%.
So the next concept we will discuss. So we learned one thing, what we need to do before starting investing we learned. We learned that we need not go for a quick money. Then we learned that we have to do something called as SIP, right? Now the problem that you all ask is where to do a SIP, okay? Now I said that there is something called as index funds. So let me clarify what index is so that you get a brief idea, and we'll introduce you to the concept of index investing. And give me your attention for next 5 minutes. Trust me, this is something, if you don't do anything at all, and if you just do this, trust me, you'll create a good amount of money. And यहाँ पे आप पैसा लगा के भूल जाओगे तो भी कुछ problem नहीं होने वाली. This is what I can assure you. So index funds, what it does is, there are two indexes in our country. One is called as Sensex, which is an index of BSE, Bombay Stock Exchange, and the other index is called as Nifty, which is an index of NSE, National Stock Exchange. Now, why did you create this kind of index? So what this index does is, Nifty is an index of top 50 companies in the country. And the BSE is an index of top 30 companies in the country. Now, with your common logical sense, can you tell me, would the top 30 in the both would be same, right? Because it's top 30, it's top 50. So what Nifty does is, the top 30 would stay the same, it will add 20 more. Now, why do we need such kind of an index or something? You see the impact. This index, Nifty 50 companies, that's top 50 companies, make up more than around 90% of our formal GDP. Now, let me give you a hypothesis. How many of you think that we are living a better life as compared to our previous generation? Please give me a raise of hands. We consume more, we go more to the hotels, we buy more branded things, phones or clothes or anything. And how many of you think that our next generation will live a better life as compared to our generation? Now, if you believe in this hypothesis, what do you think will be the companies that will make the most amount of profit? This top 50 companies. Because they make majority of part of the GDP, right? So now what we are saying is, instead of picking a stock which you may not be an expert in, why not pick an entire basket of winners and then invest in the basket? Now, some sensible person would come to me in the break and say, Tanmay, you are right that we pick up a basket of winners, but what if there is a COVID-like scenario again? Or what if there is a nuclear war? Then I say, you don't buy the contents in the basket, you just buy the basket. Now, there may be a rotten apple in the basket, it will get exchanged if it underperforms. So if it is not in the top 50, it will get out. If a COVID-like scenario comes in, you may have companies like hospitals would be coming up. You may have pharmacy companies that would be coming up. It was actually there. Pharma companies made a merry out in the COVID period. If a nuclear war comes in, then probably hospitals also would be coming up because many of the people would be getting hospitalized. Weapon-related companies or defense-related companies would be coming up. But we are buying the entire basket, so we are safe. Point number one. Point number two is, are we investing at a single point or are we investing over a long period of time via SIP? So we are doing SIP so that ensures that we are not buying at the peaks. We are getting an average return. We believe that we are average investors. We don't have time for this. So the third point is, in index investing, as we said, the next generation will have a better life as compared to our generation. We believe that probably, so I won't go into the calculation part of it. So the normal GDP is, the actual GDP is around 6 to 8%. Add the inflation, will keep on getting a 12 to 14% return over a long period of time in the Nifty. And the problem is, this 14% or a 12% won't be a 12, 12, 12, 12. It may be a 20, minus 10, minus 4, plus 30, plus 10, like that. And the average will be like this. So you need to be in the market, as sir said, for a span of more than 7 years to get those kind of returns. And as I said, the recipe for a 1 CR is already out with you. A 15,000 per month will land you in this. Sir, you want to add?
Yes, yes. Nothing. Just to understand that index, why these events won't take the index down. So there are 12 to 15 sectors in the market. Like, you know, there's a pharma sector, IT sector, and automobile, FMCG, like that. So one sector may go down, like real estate has gone down during that COVID time, the pharma sector come up. So overall, the top 50 remains top 50. That means probably the 40th company may drop down to 60, but 51st company will come back to that. So you don't require to find which company has gone down, which company is improving. You don't require an evaluation. What Tanmay is trying to tell is, it's a no-brainer. That means you don't require a finance literacy to do this. You just have to know how to operate the system, that's all.
And if you were to buy just one mutual fund, or if you want to gift it to your son or your daughter, this should be in your list. Now I'll give you another example. There is something called as active mutual funds. So when you go on a money control website or any sort of website, what you'll see thousands and thousands of mutual funds. Now what is the way you pick mutual funds? In the last 5 years, which fund has been the best performer? This is our criteria to select a mutual fund. And then when you type this, you invest your money and you see 5 years later you don't make money. Why? You know, because this funds may be a sectoral fund. This is a subcategory of a fund which invests in a particular sector. Highest risk category. Now, why do you invest it? Because you saw a past returns. But as they say in the advertise, past performance is not a guarantee for future performance. Now, there was a study which was conducted where they showed if you pick the top 5 funds, what happens to it if you invest in that 3 years for the next 3 years? Some of these top performing funds were in hundreds, rank 100. So a rank 1 in 3 years would become a rank 100 at times. So we say, so there was a very famous bet between Warren Buffett and hedge fund holders. They say we are experts, we have degrees, we know how to pick winners only and we'll get superior returns. And for that we'll charge extra expense ratio or extra commission. Warren Buffett said it is practically impossible over a long period of time to keep picking winners. So they had a bet of $1 million and after 10 years, Warren Buffett won. So he said for an average investor who is a know-nothing investor, the best way to beat the market or lot of learned people is just by doing index fund investing. They also had an experiment where they used monkey to throw the darts and pick the company. That also beat a lot of fund performers. So their conclusion was, all we have to do is index investing.
So probably only the 10% of the mutual fund can beat index funds, but that 10% may not be remain for long.
Yeah, that's why I say there's so many people who come up with, I recently met someone who had 40 mutual funds in his account. I say, sir, you won't get any returns at all. He said, why? I said, you have picked lots of losers also, lots of winners also, and there is a group. So you will end up underperforming the Nifty also. So it's ideal to have just 6 to 8 mutual funds, that's it. With that, we come to the concept of mutual funds. What are mutual funds? Just a brief overlay about it. Although I said, as we said, all you need is index funds to begin with. But then sir did describe about what are debt mutual funds and what are equity mutual funds. So for all purpose, debt will be something wherein you get fixed returns, but the risk would be very less. The returns would also be less. So example, they will give you somewhere around 6 to 8% returns, and whenever you invest, as they are getting a low amount of returns, the risk is also low. So what we say, debt is that part of your portfolio which will be used to park your funds or where you need safety. So overall, if you see, when we create a portfolio, debt is somewhere where FDs will also come, where your cash that is kept, that will also come, and then debt funds. I'll give you an example of how I use debt funds. So we had a SPS in Italy in, I think, 2023. Ankur sir was also there. And what I did, before my MCH final, I had some lump sum amount of cash which I wanted to put in the markets. But I had no time to do the research because I was busy with the exams. I also had to study to clear the exams, definitely. So what I did, I parked them in liquid funds. Now liquid funds give you around 6 to 8%. The benefit of liquid funds over a FD is when you break the FD prematurely, you will get a 1% penalty. But it is not there here. So this liquid funds, the returns that I got on this helped me to cover all my hotel expenses for the trip. So suppose we are just me and my friend. Now what they did, they kept their money in savings account. I just parked it smartly, got extra returns on it and used it to cover my expenses. So this is why I called as debt is a parking instrument. In equity side, there are 3 and 4 groups, which basically, this is a very large, broader classification. When you look into the detailed classification of mutual funds, it somewhat would look like a cephalosporin classification. So we don't want to go into that. We'll just keep it simplified. Equity is like large cap, mid cap, small cap, and then there is thematic. Most of you end up buying thematic funds. This is where the problem comes in. Because thematic funds are the highest risk funds. The lowest risk would be in equity side, it would be large cap. Because they are the funds who are very big. Can you tell me what are the chances of a company with a 1 lakh crore corpus failing as compared to a company that is a 10 CR? The chances of the 10 CR company failing would be more, obviously. So this is where we prefer to have more of large cap initially and then some mid cap and small cap.
Yeah, this basically the large cap is divided based on the market capitalization. The top 50 companies, no, they are considered large cap, then 50 to 100 they are mid, then the small cap. So as Tanmay said, you have to diversify. Diversification is the rule in stock market investing. So you should not put all the money in one basket. So even when you choose the equity, you should diversify among these three, large, mid, and small, in a different percentage. So the large percentage into the large cap, probably 50% in large cap, 30% in mid cap, and 20% in small cap. If you see the return for few years, small cap overrides the large cap, but risk also is high. Whenever the market falls, that is the one which falls faster than the large cap. So hence, always it's better to have a diversification. And as I said, the debt fund is only the short term. You should not keep a long term. Even when you make an FD, it should be a short term. You should not keep on revising for the long term.
But then when we learn कि इतना इन्वेस्ट करना है, ऐसे होता है हमारे साथ. My target portfolio 100 CR, 200 CR, because our brain thinks like that. Although when I take sessions for undergrads or interns, I say it is practically possible to have a 100 CR portfolio at the age of 60 if you start at this age. I was recently in Ames Kalyani for a talk there, and when I said this, at the end of session, everyone was like, "Sir, 100 crore तो चाहिए मेरे को, उससे नीचे तो बात ही नहीं करेंगे हम." ठीक है, but my salary is, उसके बहुत सारे zeros कम हो जाते हैं, and my SIP is 2500 रुपया. So it's not gonna work. If you have a dream of something, how do you calculate कि मैं आज कितनी SIP करूं कि मुझे वो मेरा dream पैसा मिल जाए? So for that we have something called as SIP calculator. So this is easily available. You just put it on Google SIP calculator. You will get lots and lots of free apps and those things. You have to put some entries there. So let us see how it goes. There is a monthly investment option there. So you put the money which you can put monthly. So I have taken example of here 25,000. Okay. Now expected returns you will have to put here. Now you will say मेरे को कैसे पता चलेगा expected returns कितना है, क्योंकि ये तो volatile है. So let us see, take it as a conservative note कि मुझे 12% मिलेगा जो index में मिल रहा है. I am not taking extra. इससे ज़्यादा मिल गया तो मेरा goal जल्दी achieve हो जाएगा. So I put a 12% as expected return, and time period I keep it as 10 year for now. You can do it, say, अब इसे हो सकता है कि कोई young consultant है, उसके बच्चे होंगे, उसकी शादी के लिए अभी से invest कर रहे हैं. For a disclaimer, मेरा बच्चा नहीं है, मेरी शादी नहीं हुई, लेकिन मैंने अभी से एक SIP उसके नाम पे चला रखी है, बहुत छोटी सी. It helps. It does help. It sounds funny, but then it does help. So let us see what happens in 10 years is, your investment amount is somewhere around 30 lakhs. Estimated returns is around 28, 29 lakhs, and your final corpus is roughly around 58 lakhs. This is the beauty of, so now what you can do is, if you want a 80 lakh, either increase the amount of SIP, the monthly investment, then you will get an idea कि मेरे को आज कितना डालना है पैसा, so that I can get that amount of corpus after this X years. So this planning has to be done, because what happens, हम ऑटो वाले को यहाँ से बुक कर लें, एम्स के सामने से, कहाँ जाना है, तो सीधा चल. फिर कहाँ जाना है सर, त्रिवेणी घाट आ गया, अब कहाँ जाना है, बोले सीधा चल, वो गंगा जी में डुबा देगा आपको. This is what happens with us, because we don't have a plan. क्यों invest कर रहे हैं? I usually say this to my parents also. You have created a investment or a corpus you are trying to create is for yourself also to enjoy, not just your son. So you'll have to calculate कि मेरे को इतने साल बाद ये ambition है, मुझे करना है, and this is how you can fulfill this.
You have these things in Google also. You can directly put this much is the amount for this many years. Like after 10 years, I require this much lakh or this much crore. Then how much is the SIP I have to put? So like that, you have a in the Google Forms. And one more thing is, when you invest, always you have a doubt. When should I take it out? Okay, you invested now. Next year itself, it's showing 20%, 25%. Shall I take it out? So when you are investing, the exit plans are two. Either it's a target oriented. That means after this many percentage, I'm going to take out, and like you have some prior commitment, you are going to invest, or you are going to take it out. Second thing is, you have that, I just forgot the point. You can continue. I'll come back again.
So the next part comes in where your life is going good, you are making good amount of money in mutual funds, but you will have someone in the OT who will come to you, especially the anesthetists do this. Okay, they'll come and say, sir, you are a champ, you have got lots and lots of analytical skills, why not venture into stocks? बिकॉज यहाँ पे तो मैंने अपना पैसा 10 गुना कर लिया, 20 गुना कर लिया, 50 गुना कर लिया. एंड ट्रस्ट मी, इन्वेस्टिंग इन स्टॉक्स इज लाइक हैविंग अ बेबी. इतना ही करना है जितना अपन संभाल सकते हैं, ठीक है? और अगर नहीं संभाल सकते तो नहीं जाना है इसमें. The problem happens because you need to know how to analyze a company, what the company does, what is the balance sheet, how to read a balance sheet, what are the future projections, and you'll have to keep reading. अगर नहीं कर सकते तो stocks में मत जाओ. I recently met, 2 days back, I met a senior. He was there in mutual funds. He had almost 10 lakh profit. He booked it out. Our fellow pediatric surgeon only booked the profits out, 65 lakhs, now 10 lakhs in loss in stocks. Why? Because don't know how to invest in stocks. And I say most people don't need to invest in stocks. I was doing a session with Radhika Gupta, the CEO of Edelweiss Mutual Fund on Twitter. She said most of my investment in the initial phase was around mutual funds only, more than 100 CR. So if you are having 100 CR, I don't think most of us are having it. There's no shame in having just mutual funds. We don't need to do a lot of research. We are just sorted there. So I think for most people, the important learning here is if you don't have time, don't venture into stocks because you can erode your capital there. Stay in mutual funds. If you have extra capital, spend some time learning the methodology. It's like learning the anatomy, physiology, and biochem, and then going out to do the surgery. Yeah.
Regarding that exit plan, there are two. One is after so much percentage I'm going to take out. Second thing is you have the time. Okay, for this I wanted this money. The time is reached, you are taking out.
So just a few pointers. I had lots of things to discuss, but then I didn't want to make it a lot complicated. Before after this last point, I think we can have more of questions from the audience. So this thing is, how do people lose money? So, sir.
Yes. See, the first point is called FNO, that is future and options. See, it is like I always say, like you are a pediatric surgeon, so you have studied MBBS, then MS, then the pediatric surgery, and you are doing the complex cases. What if an MBBS student comes and operate and do tracheoesophageal surgery? What do you think the result will be? Even if you see operating you as an intern, is it possible? By seeing, you may think that it is possible, but what you think will be the result? Definitely the baby will die. So the FNO is like that. So you have to be an expert. You have to understand the basics of finance. You have to learn all the mathematics and how that moves. Then only you can do the FNO. That may look like you're going to earn a lot of money over a time or over a few days' time, but that much risk will be there. So the other thing is, the people think that the money earning in the stock market is very easy. No, it is not easy. You have to learn and then you have to do it. One of the way he is telling is the index funds. That many a times we don't know the amount or a percentage. So FD means 6%. What does that mean, the 6%? We are not aware. So we only see about the amount. Probably 1,000 you earned, 2,000 you earned, but we don't calculate the a percentage. That is one of the reasons, itna hi aate. No, you have to check with the percentage. That is one, you should never do which you don't know. So the stepwise investment is always better, like what we are trying to explain you. The first step is the index fund investment, where you don't require to know much about the finance, and the only time you may lose the money means there may be some natural disaster where we don't survive here. That's the only reason. As long as the country is there, country is growing, the index will be growing. As he explained, the GDP depends on the people here. So one of the big advantage in India is the populations. As long as the people are there, they are going to use the materials, and the company is going to grow, and the index will grow. The money which you put, that 100% it's going to grow. So there is a macroeconomics wherein we call it the GDP or the value. So we are around the 3 trillion economy. So it's going to become a 10 trillion probably another 10 years time. So if the 3 trillion become 10 trillion, where does that money goes? So that is one of the reason why he is insisting be in the system. You invest in the index. If you invest in the index, you are with the country's economy and it's going to grow. That is one. Other thing is most of the time the scams. So this is one of the common things we are seeing day to day, and probably few of you might have experienced and might have lost the money also. There are few pediatric surgeons I know who lost lakhs of rupees with a simple these scams. Like you get a WhatsApp message, join this group, and we give the tips. So you join the group because you don't know anything about the finance. As soon as you join the group, there is one person who put the snapshot of the return. He got it, 10%, 20% return. Then one person will price, I got this money within 2 days, 3 days. So basically they influence you to put the money. And somehow you open the account. It's not regulated accounts. You just open the account, you put the money. Probably you may pay 10,000, 20,000. Within few days, you are going to see 10%, 20% return. So you get excited. Then you're going to put more money, 1 lakh, 2 lakh, 3 lakhs. So you see that is doubling the 10 lakhs you put in the portfolio is 20 lakhs within 3 months. So when you try to take that money out, it's not possible to take. Then in the panic, you call that person. He says, no, it's becoming double. You put some more money, but you want to take it out and test. Then he says, you have to pay tax, the 30% tax, then the money will get released. Why you have to pay the 30% tax to the broker account? That's the simple logic. So already you duped. Again, you're going to dupe by paying 30%. So like that, people are doing lot of scam. Anybody says it's easy money, just run away. That's the simplest solution.
वो हेरा फेरी में ना अनुराधा आती है वो 25 दिन में पैसा डबल तो कोई भी बोलता है 25 दिन में पैसा डबल अपन को भागना है that's the bottom line. So just a few quick pointers which were there asked by you know participants in the Google form for us. One was, can you just map out a methodology for residents? So this is what they can do. There are 3 variables: time, knowledge, and money. Money probably is just the salary or the stipend. So the focus at the time of residency should not be on the markets. It should be on acquiring the skills, because that is what will be your primary source of income after you pass out. I see lots of residents doing FNO and trading, sitting by the screen all time and then think that, okay, they'll become a crorepati like this, and they don't end up having a skill, and then this is also a problem. So focus on acquiring the skill. Knowledge, you can, so I have posted a YouTube series. There's almost, I say you just watch those 4 videos till the mutual funds. It's under the name of Tanmay Motiwala. Those are simplified for medicos. You can watch those. Spend your 4 hours. We have tried to concise things, but it will help you a lot. Then use your time. So the residency is the time period where you have money, but then you don't have time to spend it. So save 25% of your salary. Use it to have the prerequisites of investing. Start SIP in index funds. I delayed my car purchase till I was in the final year. In the last 6 months, I purchased it. But then the benefit, I'll show you how it helps is, so avoid taking EMIs or debts when you are in your residency. If you're putting 25% and if you're in a place where you get 90,000 per month, you'll end up investing 22,500 per month. If you are in a 6 years course, then probably in the first 3 years, you would have invested 8.1 lakh. The final corpus would be somewhere around 9 to 10 lakhs. If you continue this good habit, by the end of your MCH, you would be having invested around 16 lakhs, and the final corpus would be somewhere around 25 lakhs. How many of the seniors after finishing their MCH had 25 lakhs in their accounts? Please give me a hand raise. This is what creates a big difference, because you will have a financial cushion to land on and have some time to focus on whatever you want to do, or you want to take a break for your family, or you want to take some time to have a job. Because if you don't have money and if you're having EMIs, probably you will end up landing in a place wherever you want to go. And the books that I would suggest you to read in this order are Psychology of Money is a very good book by Morgan Housel. You can begin reading by this. One Upon Wall Street by Peter Lynch is something, again, you can understand. The last one is Intelligent Investor. Warren Buffett recommended this book, but when I started it in my, as a first book, I clearly couldn't get anything at all. So you can, if you don't have time, just read the chapter 8. You can note it down. Chapter 8 of Intelligent Investor. This is something which should be read. And people had asked about the apps to invest. So I use Kuvera for mutual funds. There are other mutual funds apps as well. ET Money, Paytm Money, or Grow. You can use those. Coin by Zerodha is another app. Another thing that you have to keep in mind is please buy only direct mutual funds. We have no time, so I couldn't cover the difference between regular and direct mutual funds. Most of you may be having regular mutual funds. I give you a warning. You may be paying a 1 to 1.5% extra commission for nothing. So learn about this. Invest only via direct route. Buy direct mutual funds. For buying stocks, you can use Zerodha. You can use HDFC Securities, Motiwala, any broker you can use. Zerodha is a discount broker, so that is preferable. And the other things are not preferable. Mutual funds that I own, I had put it up because someone had posted on this thing, Google form, that please list the mutual funds that you invest in. I'm not asking you, this is not a recommendation, but just invest in the index fund. So I've put it here so that you can get some idea how to know which index fund to buy. The mistake that you may do while buying an index fund is you may end up buying a Nifty Next 50 fund instead of a Nifty 50 fund. Nifty Next 50 is basically the next set of 50 companies, so you have to focus on the first 50. Don't end up buying that. And this is something we couldn't cover, so if there are any questions, we would be more than happy to take.
See, if anybody is investing mutual fund through some agent, it's always a regular fund. So, as I said, the 3 points we have to check. One is it should be a direct fund, grow and open. So, the growth and open, these 3 points should be there when you are checking the mutual fund or investing. The simple thing is, if you are already investing through a broker, you see how it is growing. A same thing can be invested directly by you, and selecting it should be a direct growth open.
Just have one question. So what is the best time to sell a stock, either when the market is going up or when the market is coming down, and you don't have a particular need either to sell or buy that stock, particularly to sell the stock?
So the point I mentioned is, one is if the growth is good, you can sell it, or if you have a requirement, you can sell it. But when you are investing in the equity market, that is any stock itself, it should be a horizon of 5 to 7 years. So to invest in a stock, you should have a knowledge. As I explained, you should know what stock you are investing. You should know about the company. If a market is falling or if the value is falling in this particular company, the first thing you have to see is the sector. For example, the one pharma company, Dr. Reddy Lab, is falling. So what you need to see, what is happening to the sector of the that company, that is sectors, pharmacy. If the sector is also falling and the company is falling, that is a good opportunity to invest more. If the sector is going and the company is falling, that is a red flag sign. And there are many red flag signs to see whether the company has any trouble or not. So for that, you need to study a bit of a fundamental analysis of that company.
There's just one more point I'll ask. Do you own a real estate by any chance? Your parents or your family? Real estate? Yeah. Roughly, what would be the valuation right now, if you can disclose? No? 1 CR, 2 CR, something around that?
Something.
Would you want to sell it to me right now?
No.
Because you know that it has grown from a particular point and it has been growing. So I always say this, I see people booking 10% profit, 15% profit. I say, owning a company is like, owning a stock is like owning a company and you're having a partial stake in the company. Would you want to sell your company to someone for a 10% or a 15%? You won't want to do that unless you are trading in it. I'm talking about investing right now. So I always say that if a company is good, if it is giving good profits, why do you want to cut the flower and then put that money into weed? What you will do? You'll take that money out and you'll keep searching kahan invest karna hai. And you'll end up probably putting that money in stock jo correct hoke baitha hoga, and you may not get time and random investing kar dete. So my criteria to sell a stock is, one, you have achieved your goal. If there is no goal, no need to sell it. Okay. Second number, if the fundamentals have changed. So what happens when you buy a company, you have a hypothesis. I'm sure not many people do this exercise, but I always write down why I buy a company and what is the future growth that I am seeing. Say I expect this company to grow by a 25% or a 20%, but the company is not doing that. Recently, I was invested in a company where the promoter started stealing the money from the balance sheet. Now this you understand when you read more, right? So now when you see that the promoter is stealing the money from the balance sheet, would you want to stay in that company? I'll sell it, right? That's the second criteria which sir was talking about. That is a red flag. And the third criteria is if the company becomes horribly expensive. So I will name a stock. I was invested in IRCTC. I think I posted it in the finance group as well. So I invested that, I had an IPO around 300 rupees, okay? The stock went to 600. Most of the people would have sold by then. In 7 or 10 days, the stock became double. My brother called me, why aren't you selling it? I said, the company is good, the fundamentals have not changed. Why do you want me to sell? The stock went until 900. 300 stock goes to 900. Now my brother comes and says, bhai, bech le, abhi to wo nahi bechega to kaise hoga? I didn't sell. The stock tanked down to 700. Hai na? And
We have 2 more sessions.
yeah,
to go.
just the last concluding remarks. So it went on, I rode it and it went on to 6,000. And then it became horribly expensive and then I sold it. So it was a 20 bagger for me. I would not have had a 20 bagger if I would have sold it in a 10% profit. Yeah, that's it.
Thank you. Thank you. I think it was a very wonderful session, very knowledgeable, and I'm sure all of us will benefit from that. Thank you very much.
One last question, please.
I just
Very
want to say
short
one
ones,
small
very
thing.
short because there are 2 more sessions and we are running very late.
I just want to say one small thing, that, you know, financial literacy for women is way down there, including myself. And I think that's not right, at least the younger generation, future. We just leave it to our spouses to do it, because we have so many other things to take care of. So, you know, for me, it is like that. You know, this half of my problem is that by my better half, and the rest of the things I'll take care. But it's not correct. I mean, all of us should be actively part.
No, women are the better investor, madam.
They are the best investors.
They're best
Women are best. But this year, I think 2 months back, I just posted in our group also and on Twitter also that I am willing to help any women in the medical background if they need any personal help from my side.
Thank you so much.
I'm willing
I
to
think
help
we'll
out.
continue the rest of the discussions over the lunch,
Yeah, we can do that. We'll be available there. Yeah.
because this is not
Okay.
going to end. It's a long
Okay.
discussion.
Thank you. Thank you so much.